gold's off, I don't know, 3%. Silver's off, was off like 7%. It starts to get into the 50s, low 50s, below 55. Take some money off the table, because I hate to see it go below 50 and then all of a sudden get back down to 38 and your average price is 35. Gold has pierced the 200-day moving average, and silver has not. Doesn't mean silver won't. In fact, most likely if gold does it, silver will as well. It might be at the $4,200 level, which is, a couple $100, lower 150 from where we are now. On the weekly, it's not as powerful. You don't get real support in gold until you're in like the 3,500 range or so.
We also just talked to Alistair McLeod of China, restricting exports of silver, making that a bit more difficult, and importing quite a bit of silver.
The same economic data that's pressuring gold and silver today is also creating stress elsewhere. The bond prices fall as yields rose. And what happens if the stock market sells off? The answer is very clear. The metals sell off at the same time.
Just as silver has sold off significantly overnight, what is your take on where we are?
Well, obviously, I just actually did an update for our members, paid members, and we had a big sell-off, as you said. I mean, gold's off, I don't know, 3%. Silver's off, was off like 7%. Platinum, palladium were off 5.5%. So, and the shares were off substantially as well. So where I think we are is, a day of, selling, and what does that really, really mean? And I think we have to look at the big picture. I mean, one of the things that we're talking about is the farm payroll thing came in stronger. That's an excuse, but the long-term fundamentals haven't changed. It's important to bear in mind. And the update I did for members was basis the daily and the weekly charts. And on a daily chart, we've broken the 200-day moving average in gold. We have not broken it in silver. I didn't look at platinum. And on the weekly, they're still both above the 50-day weekly moving average. So from a longer-term perspective, I mean, the mainstream uptrend is still intact basis the weekly, but everyone trades off the daily. I mean, how many thousands of contracts in soybean meal, gold, silver are done every day during trading hours, and today's no exception, big sell-off. But nonetheless, and so I think the short term, we have to watch it closely, and there's not a lot of support for a while. Gold is led on the way up, but gold's leading on the way down, and I'll just repeat, give it back to you, Elijah, but gold has pierced the 200-day moving average, and silver has not. Doesn't mean silver won't. In fact, most likely if gold does it, silver will as well. It just is interesting that silver's actually performed better technically than gold has. I'm not saying percentage-wise. Gold has held on to its percentage gains stronger than silver, which is normal. I mean, silver is more volatile.
Markets just punish metals on one job's headline while ignoring the debt structure underneath the entire system. As David Morgan points out here, gold breaking a major technical level matters less than why silver refused to confirm the move. Retail investors are trained to react to daily candles, while institutions reposition across quarters. If payroll strength truly solved economic fragility, bonds would not remain under pressure at the same time. For wealth preservation, the question is whether this was liquidation or conviction. Next, David Morgan exposes why the market's reaction to stronger data may actually signal weaker confidence beneath the surface.
You mentioned how nothing fundamentally has changed, but those key technical breaks, I think, are significant. Do you anticipate a lot of further downside due to that, just on a technical level?
Not yet. Well, let me restate it. I'm waiting to see more data. I mean, that sounds like an excuse, but it really isn't. I mean, there are times when you breach the 200-day, it's a one-day event that comes back up. That's extremely rare. So based on probabilities, we are going lower. And the first, reprieve might be at the $4,200 level, which is, a couple $100, lower 150 from where we are now. On the weekly, it's not as powerful. You don't get real support in gold until you're in like the 3,500 range or so. Not saying it's going there. I just am reading the charts, and they are objective. The data is objective. How you interpret it, that's a different story. There's all kinds of technicians that'll see the same chart and generally get the same ideas because we're all kind of taught to look at it the same way. But nonetheless, there could be further weakness in the metals. Fundamentally, there isn't. If the shares stay strong, which is kind of a key indicator here because they're actually holding up better than the metals, believe it or not, then that will be a strong indicator, Elijah, that I'm convinced that we got a close call, you might say. We got a test of our metal, M-E-T-T-L-E. It's holding, and we're going sideways further and higher. But time will tell.
I think a lot of analysts are looking at that $50 mark for silver. What are the potential downsides if we do start breaking some of the technical levels on silver that you see?
Well, unfortunately, and you hit the nail on the head. I just finished this update. 50 is kind of the crossing the Rubicon.
This exact sequence has appeared before major resets. Technical damage first, narrative adjustment later. According to David Morgan, probability matters more than prediction once major moving averages fail. The overlooked signal is not the metal itself, but whether miners continue resisting the downside. Markets often overshoot before fundamentals catch up, and investors who confuse volatility with thesis failure usually transfer assets at the worst possible time. Next, David Morgan reveals the threshold where silver stops being a correction and becomes a regime change.
In fact, I think I even wrote an article with that title or something close. I told my members, look, if you've been with me for any length of time and your average price is as high as 35, and it starts to get into the 50s, low 50s, below 55, take some money off the table because, I hate to see it go below 50 and then all of a sudden get back down to 38 and your average price is 35. So what I told my members was it's an individual choice. Some people are going to sell, some want to sell, some don't want to sell. There's lots of reasons for people to take profits. And I'm not a big advocate of turning real money into fiat, but there's reasons to do so on an individual basis. To pay off your house, to, buy a second house, to buy a business, to pay off a student loan for your grandkid, whatever it might be. That's in a way none of my business. The point is, I don't want to see anyone that follows my work to give up all of their profits. I don't want to see someone, its average price is 35 after 10 years, watch it go to 121, not sell into my recommended, take some profits at over 100, to see it come back down to, where we are now, and then watch it go all the way down to 50, So I just, want people to bear that in mind. People say, no, I'm never selling. I'm only giving it, to my kids, whatever. That's a different story. That's their individual choice. But and the other thing is overweighting. I've recommended 10% for basically the startup of the Morgan report. And there's an argument for 20%. There's an argument for more, but 10 is kind of the rule of thumb.
The fastest way to destroy long-term gains is believing conviction means never taking profits. What David Morgan is highlighting is that preserving wealth and maximizing upside are not the same strategy. History shows investors rarely fail because they bought too early. They fail because they never rebalance after success. If metals become an outsized share of your net worth, you are no longer hedging risk, you are concentrating it. Next, David Morgan exposes why disciplined profit-taking may outperform permanent holding in volatile cycles.
Well, with what the metals have done in the last 2 years, Elijah, that your portfolio might be 20 or 25% because of what the metals have done versus real estate or versus the stock market. So if you balance your portfolio on a weighted basis, and your portfolio, which is supposed to be 10%, is 25%, common sense kind of says, all right, sell some of the profit and then reinvest in some of the undervalued assets. Although I don't consider real estate or the stock market to be undervalued, but I think you catch my idea. And that whole systematic approach on an annual basis came from the late great Harry Browne, who was a candidate for the Libertarian Party for two different presidential runs. Didn't get many votes. Libertarians never do, but very well thought. I would call it the permanent portfolio, which is a very good way to invest as far as being diversified and making a steady eddy profit in all conditions, inflation, deflation, stagflation. So give it back to you.
I think another thing to look at right now that a lot of people are pointing out is what are the big players doing, right? What are the nations doing? What are the institutions doing? You've talked about just recently, I think on one of your Morgan Report videos, how it's a lot of the big money is acquiring real assets right now. And we also just talked to Alistair McLeod, who was talking about how there really has been a shift in how the big players have been moving, especially if you look at the nation state level with China, restricting exports of silver, making that a bit more difficult, and importing quite a bit of silver. And I guess your take on that, what are the big players doing right now, and what kind of insight does that give us for deciding, what are good plays at the moment?
Very good, Elijah.
The public conversation is still about inflation, while large players keep accumulating things that survive monetary resets. David Morgan's argument suggests the real signal is not price action, but allocation behavior beneath the headlines. When sovereign actors and institutions tilt towards strategic assets while retail debates daily volatility, the information gap widens. Portfolio protection is rarely built during panic. It is usually positioned before consensus recognizes the shift. Next, David Morgan walks through why institutional demand and public messaging are moving in opposite directions.
Yeah, let's step back and look at the bigger picture. The same economic data that's pressuring gold and silver today is also creating stress elsewhere. The bond prices fall as yields rose, and that's the bigger picture. As we all know, or I should say all, but probably most of us in the precious metal space know that the reserve asset now primarily is gold over U.S. Treasuries. That is significant, especially when the bond market is key and it's weak and probably getting weaker. So growth stocks sold off and the broader market weakened. In other words, today's move is not a vote of confidence in the economy whatsoever. So that's where this contradiction. On one hand, we're told the economy is strong, that could support higher interest rates. But on the other hand, government debt continues to expand, deficits are enormous, and interest costs on that debt continue to rise regardless of the jawboning that's done by the mainstream financial press and the political class. So the economy may not be as strong as we're told, and the next response may be further pressure on interest rates to the upside. In my view, today's sell-off is more about liquidity than it is a fundamental change. Remember, gold remains dramatically higher than it was a year ago or 2 years ago, and silver's far above levels some of us only dreamed about a couple of years back. So central banks are still accumulating gold, as you point out. Thank you. Sovereign debt levels have not improved, and geopolitical tensions have far but disappeared. I mean, they continue to get more concerning as the clock moves forward. So none of the reasons investors sought refuge in precious metals have gone away. In fact, they probably strengthened. So now just to touch a bit on the mining shares, and the mining stocks essentially are leveraged plays on the metals, as we know. When gold falls 3%, you could see the metal stocks fall 6, 7, 8, 9, 10. And that's what's happening today. But
the Fed keeps describing resilience, while bond weakness is quietly signaling something very different. This is where David Morgan's thesis shifts from price watching to system watching. When yields rise, stocks weaken, and central banks still accumulate hard assets. The official growth narrative starts colliding with institutional behavior. Liquidity events often look like confidence until you trace where capital actually migrates. For investors protecting purchasing power, that distinction matters more than headlines. Next, David Morgan reveals what institutional allocation is saying about gold that public messaging refuses to admit.
But ironically, many of the mining shares today are generating stronger cash flows than they were when the metals were priced significantly lower. So where does that leave us? I think and it's important to distinguish between short-term volatility today or the next week or maybe next month and long-term trends. Short-term trend has weakened, no doubt. The market's adjusting to the possibility of higher rates for perhaps longer than most people expect. And the long-term concerns, debt deficits, currency debasements, geopolitical instability, and growing distrust in the financial system remains firmly in place. So if anything, today's actions probably highlights just how sensitive the markets are. And everybody's got a computer and a little device that they carry around with them all day and night. And because of that hypersensitivity, there's probably some overreaction in the metals markets. But nonetheless, I would suggest unless you want to or need to lock in profits, you consider one doing that if you want or need to. But if you are for the longer term or you're newer to this market or you're young, I would just stay the course.
I think those are very good points there. A lot of people have been, you're saying that it's kind of a liquidity event right now. A lot of people have been concerned that that could intensify as we see, a huge tech bubble. A lot of people are talking about, and as we speak, the NASDAQ is falling significantly here. I think it was down 1,000 points or so, if I'm not mistaken. Almost 1,000 points today as we speak. And so your take on that. Do you anticipate further, a further sell everything moment just because of the popping of this bubble?
Usually when you get these, what I call waterfall declines, a waterfall, fits your waterfall.
Markets can punish miners even while the underlying businesses become more profitable. And that contradiction rarely lasts forever. David Morgan notes that investors confuse price with value most aggressively during liquidity stress. If mining cash flow improves while sentiment collapses, someone is either mispricing risk or preparing for weaker money ahead. The danger for savers is selling productive assets to chase narratives that already peaked months ago. Next, David Morgan exposes the hidden difference between volatility selling and structural weakness.
You're on a ledger straight down rapidly. So normally when you get like 1,000 points, as you mentioned, that is the start of a waterfall decline. There's a rule of thumb. Doesn't happen every time. Usually it's a 3-day event. So depending on how the books square at the close of the market today, if the working group on financial markets, aka the pledge protection team, comes in an hour before the close and buys a holy living amount of options in the S&P and starts to push it up because of buying power, that could quell it. But the probability, Elijah, is most likely we'll see a couple more days. So I expect that the most likely is more decline Monday and Tuesday, or Monday into Tuesday, maybe a rebound on Tuesday of next week, and then probably a settling. And to further expand on what you alluded to, this is not an expecting a large decline. I don't know how many times I've been asked, what happens if the stock market sells off? The answer is very clear. The metals sell off at the same time. Now, if you talk to Michael Oliver, and you have, and lots of respect for that man and his work, and he'll point out that it's usually a very temporary thing, that the metals may fall temporarily with the overall stock market, but they'll be the first to rebound. And we know that as a fact in almost all cases, but primarily in the great financial sell-off in the 2008 quote-unquote financial crisis. Gold went down, I think, 30%. Silver went down more than 50%, if I recall correctly, a much larger percentage. But both caught a bottom much faster and moved up much quicker. Gold almost doubled from the bottom, and silver went up about 5-fold from the bottom. I'm not saying that's just going to occur here. What I am saying is,
this pattern appeared before prior liquidation phases. Everything sells first, leadership emerges later. According to David Morgan, waterfall declines often compress fear into a handful of trading sessions, rather than a drawn-out collapse. The overlooked detail is that metals historically get sold to raise liquidity before reasserting their own trend. Investors who mistake forced selling for failed fundamentals often lock in losses exactly when conditions begin changing. Next, David Morgan walks through the timeline when capital rotation starts reversing faster than retail expects.
If you want to sell your metals and metal stocks here because they're lower, they may only be lower on a spike, lower that waterfall decline for a few trading days, and all of a sudden they settle out and they start back up. And unless you're really nimble, you might be buying them back at the same place you sold them. I can't guarantee that, but I've been in the markets for 4 decades. I got a pretty good handle on things. Not perfect, but I kind of, have some foresight into what the probabilities are and what are most likely to occur. So if you've weathered this far and you're a long-term investor, I think I'd probably just hold.
If this continues for another few sessions, emotional decisions, not price declines, become the biggest threat to portfolios. What David Morgan is highlighting is that forced exits and strategic exits are not the same event. Historically, sharp sell-offs reward speed only for a minority and punish everyone else through mistimed re-entry. Long-term investors rarely lose because markets move. They lose because volatility changes their behavior at the worst possible moment,